Frequency Podcast Network. Stories that matter, podcasts that resonate.
It's a holiday present to anyone who owes money or for those looking to renew a mortgage, and you didn't even have to wait for Santa. A fifth interest rate cut by the Bank of Canada, and for the most part, the announcement played out as expected. It was a 50 basis point cut, and it came a few days after the latest jobs report showed our unemployment rate rose to its highest level since 2017 outside the pandemic at 6.8%. One economist says this interest rate announcement is particularly interesting because it's coming at a time when there are so many unknowns. I'm Kris McCusker, and today on the Big Story podcast, that economist joins us now. Jules Boudreau is Senior Economist at Mackenzie Investments. Thanks for doing this.
Thanks for having me.
Walk me through how you see this interest rate announcement today. I guess it wasn't really a surprise, but was there anything, or maybe what stood out the most to you?
I think the actual interest rate decision wasn't a surprise, but I think a big surprise was the language in the statement saying that they would not necessarily keep lowering interest rates going forward. And we also heard that reflected in Tiff Macklem's statement and answering questions during the press conference. In previous decisions, even if we just go back to October, there was a clear language saying we cut rates and we're going to keep cutting rates going forward because we think the Canadian economy needs it. And there was a big change in this statement where instead it says something like we'll evaluate the need for further cuts as data comes out, which is, in my view, a huge change. So I would say that the 50 beeps is not a surprise. That's what we expected. But this change in language is a big surprise to us and to markets.
Okay, so what does that mean for you? The fact that, they went back-to-back half-point cuts, but maybe this is it now. What do you take from that?
What I take personally from the change in the language is that they don't want to keep cutting by 50 beeps. They want to ramp down to 25. And that's their way of saying so, of telling markets and investors and Canadians, don't expect 50 beeps cuts going forward forever. Yes, we did 2 of them, but now we want to ramp down back to normal size cuts. That's the way I hear it. My issue is I don't think that's the way that a lot of people will hear it. And also, I think it reflects a kind of weakness in the Bank of Canada's thinking. Maybe weakness is a big word, but I think their thinking now is, okay, we cut rates a lot, and so rates are getting close to appropriate. I think that's a mistake. I think rates are still much too high at 3.25%. That's still a level of rates that slows down the Canadian economy and prevents it from bumping up. I don't think it's a big deal to go back down to go down to 25 beeps pace. We'll get data before January. Maybe that's going to be warranted once we get to January. But I think it reflects maybe a sentiment of a job done or job close to be done, which I think is a mistake. And I'm also worried that Canadians will see that as we're done. In the same way that back in January 2023, when they said, we might start cutting, they were thinking, okay, we'll get 4% of interest rate cuts, and instead they hiked in 2023. So I think this is going to have maybe a little bit of the opposite effect of, okay, is this over? I don't think it is, but it's a risk that people will take it as an indication that it is over.
Okay, so let's play that out then. If people do take it as an indication that that's it for cuts, period, quarter point, half point, doesn't matter, no more cuts. What does that look like? Like, wouldn't that kind of hold people back rather than spending money they don't have?
It would hold people back. And I think in the current environment, that's not what we need. The Canadian economy, we're not in 2022 or 2023 anymore. The Canadian economy, in my view, is pretty close to a recession or in a recession. We also heard Stephen Poloz talk about that, the former Bank of Canada governor, saying he thinks we are in a recession. I would tend to agree. There's some data that's masking it, but in general, we're in a recession. And when you are in a recession, the only way to get out of a recession without a very large increase of the unemployment rate is to boost the economy, either through government spending or through lower rates. Government spending, we're getting a bit of it, but not that much. So what we need is lower rates. If Canadians think that 3.25, that's it, that's not a low rate for the Canadian economy. That's still a high rate. At 3.25%, Canadians are going to skimp on purchases. They're going to, Canadian businesses are going to stop their investment. So I think it is a big risk. We're seeing a few signs of the Canadian economy strengthening, but not a lot. And if this is it, then it will be a problem. I don't think it is it. I think we're going to end up going lower, but I think this is a risk that is kind of going on top of all the other ones we've seen for the Canadian economy over the past few weeks. We have the Trump tariffs, and now on top of it, this might be it for Canadian interest rates, where I think we should be a bit more aggressive in supporting the Canadian economy.
Okay, so let's say that people do take it that way, that that's it for interest rate cuts. What does that do to the real estate market?
Yeah, a very rough period for the real estate market, if that is it, and if people think that it is it. We saw some bounce in the real estate and housing market since the start of 2024, for sure. But I would say that the bounce that we saw is not comparable or what we would have expected with the rate cuts that we've seen. Going from 5.5% down to 3.25%. If you had asked any analyst or any economist 2 years ago, what would that do to the real estate market? They would have said, it's going to be on fire. We'll get 20% price increases. That's not what we've seen. We have seen a little bit of increase in activity, but not as much as we would have expected. And to me, that's a sign that the real estate market is pretty weak. It's getting better because of these rate cuts. But if those rate cuts stop, then that's trouble, because that's what was sustaining it. We're also getting these lower immigration targets. We'll see how much they're realized, but most likely we will get lower population growth over the next few years. So that combined to interest rates staying above the neutral rate, so above the rate above which the Canadian economy is getting slowed by interest rate, which we think is around 2.5%, that could spell trouble for the real estate market. Nothing close to, a catastrophic scenario, but we are dependent on the Canadian real estate market for the Canadian economy to bounce back. If the housing market peters out, that's going to mean that this recovery that we're trying to get out of this maybe recession, is also going to get impacted.
Okay, so this creates an interesting landscape. Now, if people do sort of take what they heard from the bank today as a, this is it for cuts, period, none going forward, would there be any thought by the bank in cutting again in January to alleviate some of those potential concerns?
We actually do think we will get a cut in January, a 25 beeps cut. We think that's pretty clear. Rates are still too high. And like I said, I think that this language by the bank is more intended to say we're not going to keep doing 50 beeps. We're going to do 25. But I do think that, yes, if markets and Canadians take it as, we're going to do zero going forward, then you have to backtrack on it, because the Canadian economy is going to be too sensitive to that. We're also going to get, Trump is going to enter office in, around the next decision, right before. Those tariffs could come much quicker than maybe the bank is even anticipating. We could end up, having significant tariffs maybe in the first quarter of 2025 through executive action. Probably not, but you could. And if that combined with, Canadians think that interest rates are at 3.25%, and maybe we get a bounce back in the Canadian dollar value, and signs from financial markets that people are taking this for granted, that we're done, then they do have to backtrack. And not only, I think, do a 25 beeps, which we expect either way, but also maybe bring back this language in the statement and everything else to say that they will have to cut further, and that the rates are still too high.
You've cited the Trump tariff threat, some of the other stuff, government spending and such. We've heard in Ontario and BC, there's been talk about, checks going out. There's this GST holiday. So here's my next question around, potential for interest rate cuts going forward. What happens to inflation? I mean, we don't know what we don't know, and I don't know if your crystal ball is working, but like even just the Trump tariff threat is potentially inflationary.
To me, the Trump tariff threats are deflationary for Canada. They're inflationary maybe at the margin for the US, but for Canada, Trump tariffs with the size that we're seeing, not necessarily 25, but even at 10% across the board, that means lower growth and lower inflation in Canada in general. It depends if we retaliate. If we do retaliate one for one with these Trump tariffs and we ourselves put 10% tariffs on US exports to Canada, then through import inflation, we would get higher prices. That's true. But if we don't retaliate, that means lower inflation. And even if we retaliate, at the margin, the effect on inflation, to me, is going to be pretty minor compared to the negative impact on growth. And I think that if we do get these Trump tariffs, 10, 20, 25%, whatever, whether we get exemptions or not, the net impact is going to be a further hit to Canadian growth, which means in general lower inflation in the future, and which means, more importantly for the Bank of Canada, lower rates going forward. I think there's a scenario where in the cyclical environment in which we are in Canada right now, you add sizable tariffs on top of that, and you need rates around 1.5, 2% just for the Canadian economy not to get worse. It decreases the level of interest rates that is your neutral rate at which you want to get to just stabilize the economy. So in my view, we might not get the Trump tariffs, but if we do, it means lower growth significantly, probably lower inflation at the margin for Canada, and it means lower interest rates. And maybe to talk a bit more about that, I think there's a philosophical debate to be had at the Bank of Canada right now, because what we heard from Tiff Macklem is that the Bank of Canada is going to take into consideration these Trump tariffs in its outlook when they're implemented, not before, which I don't think is a necessarily bad way to do things, but it can lead to mistakes. You know that these tariffs might come. You know that if they do come, they'll have a serious impact on your economy, and Tiff Macklem said so. So why not start baking them in relative to your probability that they will happen? If you think it's going to be around 30% that they happen, you should bake that in. And there's nothing wrong in maybe being a bit more aggressive with the rate cuts until we get there, and then maybe increasing rates back in 2026 if those tariffs don't come. But the risk right now is that we know right now that there's a risk of tariffs, and we wait to react to them, and then by that time it's too late. So there's no right way to do it, but I think that ignoring them and not taking action right now for the probability that they do happen could end up being a bit of a mistake, although I would say that it is a hard thing to do and not an easy problem for the bank to solve.
Well, and I sort of get it. I mean, there was a threat of tariffs with his prior administration, and then it didn't happen. So, I mean, it's hard to pencil something in if the likelihood of it happening is unclear.
Especially with someone that is as volatile and uncertain as Trump. I will say that's a very good point. But I do think that here the risk, if it does get implemented, is so high that even if you're just pricing in a 20% chance that it does get implemented, that's enough to me to move the needle. But I agree, it is a kind of philosophical question of, do you want to do it now or not do it? It's kind of the same thing we've had that situation in the past with budgets. If we go back to 2022, when the Bank of Canada was saying, okay, we don't think we have to raise rates super aggressively. We've heard that maybe we'll get some extra spending from the federal government budget, but we want to wait until we actually see the numbers. And I think that was clearly a mistake. We knew in advance that we'd get extra spending in the 2022 budget. And when it came out, it was inflationary. And the bank could have reacted to it. Yes, it wasn't confirmed that we get the spending, but you can hedge your bets a little bit based on the probability you think something happens. Again, tough to do, even tougher to do in this case when you have Donald Trump on the other side. But it's something you need to think about to not be always behind the curve.
I get what you're saying. It's better to be proactive and then take it away rather than not put anything in place and have to play catch up.
I would say so, and especially at a moment where we're already in a vulnerable position from the Canadian economy standpoint. If we were like in 2018, 2019, where the Canadian economy is doing pretty well, and you're like, okay, there's this extra risk maybe that these tariffs get ramped up from Trump, maybe you can say, okay, we'll take that risk. But right now, where the risk is further downside to this weak economy, further upside to this unemployment rate that's risen at a historically fast pace, I think here you should maybe bias a little bit towards hedging that risk.
The other thing I'm curious about, what happens to our loonie short term?
Yeah, we've been on the weaker Canadian dollar bandwagon for a little while now, since maybe the start of 2024. Obviously, we don't think there's this same downside to the Canadian dollar value that we've had over the past few years, but we do think there is still some downside in Canadian dollar value. We're seeing it around 141 in terms of USD CAD. We think we'll get towards 143, 144, especially if these tariff risks don't fade. The Canadian dollar, considering the weakness of the Canadian economy, considering we expect more interest rate cuts by the Bank of Canada than markets, and considering that just structurally in the long term, the Canadian economy has some trouble, the Canadian dollar is too expensive. And I know that can surprise people, especially those that remember the halcyon days of 2011. We were at parity, and then I say, 140, that's too strong for the Canadian dollar. They're like, well, what are you talking about? It's way weaker than back in 2011. And it's true, but the economic environment has changed, the relative power of the two countries, the oil and energy environment has changed. U.S. was the largest importer of oil back at the start of the 2010s. Today, it's the largest producer in the world and a net exporter, while Canada, its energy sector has decreased as a weight of GDP. So it's not the same environment. So for us, 140 is not particularly a weak Canadian dollar. We could see some further deterioration, and we do expect to see 143, 144 in 2025, but not much further than that, because at some point you get some market forces that should bring it back a little bit higher.
Well, and the other thing too, as far as consumers go, a weaker Canadian dollar is not a good thing, but there are positives to a weaker Canadian dollar too.
There are, especially when you're getting hit with tariffs, right? If you're an exporter, I don't know, you're making widgets in a factory somewhere in Hamilton, you're exporting them to the US, and then you get hit by a 10% tariff. Well, if the Canadian dollar reacts by depreciating by 5%, that's great for you, because the effective tariff is now only 5%. So that's the point of having these flexible exchange rates. And that's also why the Bank of Canada governor is loath to push back on Canadian dollar moves, because they're there to absorb economic shocks. So if we do get these Trump tariffs, I think and I hope that we get a big depreciation in the Canadian dollar to smooth that shock for Canadian producers and those exporting to the US.
Okay, so if I were to sum up our conversation, what is your big picture viewpoint on the Canadian economy, given the interest rate announcement that we have seen today?
The Canadian economy is weak. It's probably close to a recessionary environment. To get out of this recessionary environment, we need one of two things. We need a lot of fiscal spending by the governments, or we need Bank of Canada rates going down to at least 2.5% to 2%. We're not going to get the big fiscal spending. We'll get a little bit of it, but not a lot. So what we do need is lower Bank of Canada rates. I think that the 50 beeps cut that we got today is a good step towards that. But the fact that the Bank of Canada signaled that it's taking the foot off of the accelerator could be an issue for the Canadian economy that has shown very little signs to me of inflecting higher and getting back to a healthy 2.5%, 3% growth rate.
Thank you so much for doing this. You've been very generous with your time.
Thanks a lot, Kris.
That's Jules Boudreau, Senior Economist at Mackenzie Investments. And I'm Kris McCusker. Thanks for listening to the Big Story Podcast. You can find us on the Seeker app, SEEKR.